This video is for educational purposes only and reflects personal experience. It is not financial advice. Options trading involves risk. Please do your own research before making any investment decisions. What if I told you there's a strategy that lets you collect cash upfront just for agreeing to buy a stock you were already planning to buy? Not a get-rich-quick scheme, not margin trading, not day trading. It's called a cash-secured put, and it's one of the simplest option strategies that most retail investors have never heard of. In this video, I'm going to explain exactly how it works, walk through a real example step by step, and tell you the one situation where I learned, the hard way, never to use it. Let's get into it. Before we get into the mechanics, let me give you the plain English version. When you sell a cash-secured put, you're essentially saying to the market, I'm willing to buy 100 shares of this stock at a specific price, and in exchange for making that commitment, you pay me a premium today. That's it. You're selling the right to someone else to sell you shares at an agreed price. They pay you for that right up front, and you keep that money no matter what happens. Simply, you agree to buy stock at a price you have set. The buyer of the option pays you a premium, and you keep premium regardless. There are three terms you need to know. Strike price, the price you're agreeing to buy the stock at. You choose this. Premium, the cash you receive upfront for making the agreement. This is your income. Expiration date, the date the agreement expires. After this date, it's done, one way or another. And cash secured just means you actually have the cash sitting in your account to buy those 100 shares if needed. You're not borrowing. You're not using margin. Let me walk you through a real example. I'm going to use round numbers to keep it clean, but this mirrors the type of trade I've done myself. Stock XYZ is trading at $100. You'd be happy to own it at $92. You sell a put with a $92 strike price, expiring in 30 days. The market pays you a $1.50 premium per share. Because one options contract represents 100 shares, that $1.50 premium means you collect $150 immediately into your account. Let's have a look at what is your return on the capital you have set aside to secure this trade. The capital you set aside that is your cash secured is $9,200. The premium you have collected on this 30 days option is $150. The return the trade generated is approximately 1.6%. If you were to run this trade 10 to 12 times per year, you are looking at upwards of 16% return on capital. Now, there are two ways this resolves. Scenario A. Stock stays above $92 at expiration. The put expires worthless. The buyer doesn't exercise it. You keep the $150 and you still don't own any shares. You're free to do it again next month. Scenario B. Stock drops below $92 at expiration. You get assigned 100 shares at $92. But remember, you actually wanted to own this stock at $92, and your real cost basis is even lower. $92 minus the $1.50 you already collected equals $90.50 per share. So in the worst case, you buy the stock you wanted at a discount you set yourself. That's the core of the strategy. You're essentially getting paid to place a limit order. To execute the trade, first you must check the earnings calendar for the stock you're looking at. Never, again, never, make a trade where the earnings announcement falls before your expiration date. Second, select the expiration date. Typically 20 to 45 days out works well. Third, choose your strike price, below the current price, at a level you genuinely want to own the stock. Lastly, sell to open, not buy. You'll see the premium credited to your account almost instantly. The cash to cover the trade, 100 times the strike price, needs to be in your account. Your broker sets it aside as collateral while the trade is open. That's the cash secured part. I want to be direct about the risk here because there's a version of this strategy that can hurt you. If the stock drops sharply, say from $100 to $70, you'll be assigned shares at $92, which means you're immediately sitting on an unrealized loss of around $21.50 per share, after accounting for your premium. That's a real loss. On 100 shares, that's $2,150. This is why the foundation of this strategy is stock selection, not premium hunting. You should only sell cash-secured puts on stocks or ETFs you genuinely want to own, companies you've researched and believe in long-term, positions that represent a size you're comfortable holding. The premium is a bonus for being willing to own something you already wanted. The moment you start selling puts just to collect premium on stocks you wouldn't want to hold, you're taking on real risk for the wrong reasons. Here's the thing I wish someone had told me when I started. Never sell a cash-secured put in the week before a company's earnings announcement. Reason 1, binary risk. Earnings are binary events. The stock can move 10%, 15%, even 20% in a single session in either direction. No amount of premium justifies that kind of gap risk on a short put. Reason 2, IV crush works against you here. Before earnings, implied volatility spikes, which inflates the premium and makes selling puts look attractive. But if you sell into that elevated IV and the stock gaps down, you lose far more than the inflated premium you collected. I learned this firsthand. I sold a put on a stock the week before its earnings. The premium looked great because IV was elevated. The stock missed estimates, gapped down 12% overnight, and I was assigned shares at a price well above the new market price. I held and eventually recovered, but it tied up capital and cost weeks of stress that were completely avoidable. The rule I follow now: check the earnings calendar before any new cash-secured puts. If there's an earnings announcement before expiration, I wait. It's that simple. So, is a cash-secured put right for you? It's a good fit if you have capital sitting in cash earning nothing. You already have a watch list of stocks you'd be happy to own. You're patient. You're happy to wait 30 days for a trade to resolve. You understand that this is an income strategy, not a home run strategy. It's not a good fit if you're looking for leveraged upside. You don't want to own the underlying stock under any circumstances. You're uncomfortable holding a position through short-term volatility. When it works well, this strategy puts your idle cash to work, generating income, while giving you the chance to buy stocks you believe in at a discount. When it doesn't work perfectly, you end up owning a stock you wanted anyway, at a lower price than the market was trading. That's a trade-off I can live with. In the next video, I'm going to go deeper: how to choose the right strike price, how to manage a cash-secured put that's going against you, and how this connects to the full wheel strategy. If you found this useful, subscribing means you won't miss the next one. And if you have questions, drop them in the comments. I read every one. See you in the next video.